Welcome to the Deep Dive. Today, we're really digging into the StandardAero first quarter 2025 earnings call.
Yeah, we heard from the key execs, Russell Ford, Dan Satterfield, Alex Trapp, and they introduced Rama Bandata, the new VP of IR.
Right. And, the overall tone felt pretty positive from the get-go based on the numbers they shared.
Oh, absolutely. The results they posted for Q1 definitely pointed towards a strong start to the year.
Okay, let's jump right into that snapshot then. What were the main numbers?
So for Q1, revenue came in at $1.44 billion.
Okay.
That's up a solid 16% compared to last year, and 14.4% of that was organic growth. Pretty strong.
16%, wow. And profitability.
Yeah.
How did EBITDA look?
Adjusted EBITDA was $198 million. That's a 20% jump year over year.
So growing even faster than revenue, that implies margin expansion, right?
Exactly. The adjusted EBITDA margin hit 13.8%. That's a 40 basis point improvement over Q1 last year.
Nice. And net income. I remember that being quite a leap.
It really was.
Yeah.
Net income landed at $63 million for the quarter. Compare that to just $3 million in Q1 of 2024.
That's a huge difference. Okay, turning to cash flow is sometimes tricky in Q1. How was it?
Well, free cash flow was the use of $64 million. But management stressed this was, expected seasonality. Typical Q1 stuff, working capital build, paying year-end taxes.
Right. The usual pattern. But was it better or worse than last year?
It was actually a $38 million improvement compared to the cash use in Q1 2024.
Yeah.
So moving in the right direction, even with the seasonality.
Okay, good context. And the balance sheet, debt levels.
Leverage improved quite a bit. Net debt to adjusted EBITDA finished the quarter at 3.09 times.
3.09x, how does that compare?
That's way down from 5.7x a year ago, and even a tick better than the 3.13x they ended 2024 with.
So deleveraging nicely. Okay, the headline numbers definitely paint a positive picture: growth, margin expansion, lower debt. Let's peel back the layers now. How did the segments perform, starting with engine services?
Engine services put up good numbers. Revenue was $1.3 billion, up 16%.
Driven by
mostly commercial aftermarket. They highlighted turboprops, and interestingly, a record quarter for the CF-34 engine work. Business aviation also kicked in some growth.
What about military within that segment?
Military was flat year over year. They put that down mostly to just timing, when engines physically arrive for service.
Okay. And the profitability in engine services, did margins expand there too?
Adjusted EBITDA also grew 16%, tracking revenue. But margins were roughly flat compared to last year.
Ah, okay. Why was that?
Management pointed to mixed headwinds. Specifically, the costs associated with ramping up the new LEAP and CFM 56 programs. These are big, important programs, but they start out with lower margins as they, get the processes fully dialed in.
That makes sense. Those big ramps often have initial costs. All right, let's switch to the other segment, component repair services, CRS. How did they do?
CRS had a really standout quarter. Revenue jumped 21% to $167 million.
21%. Was that all organic?
Not entirely. The ATI acquisition added about $22 million. But there was strong organic growth too, especially in land and marine aeroderivative programs.
Any headwinds mentioned?
Yeah, a couple of temporary things. Some downtime from consolidating facilities, and they decided to exit a lower margin hydraulics product line to focus elsewhere. They also flagged that some expected input timing might shift into the second half.
Got it. But despite those minor things, 21% growth is strong. What about CRS margins? That's often the higher margin part of the business.
And it certainly was this quarter. CRS adjusted EBITDA grew 32%. That drove margins up over 240 basis points, hitting 28% for the quarter.
Wow, 28% margin in CRS. What drove that improvement?
It was a combination of productivity gains, pricing actions working through, just good operational performance, and importantly, realizing synergies from that ATI acquisition.
Okay, so CRS really firing on all cylinders. Pulling back up, what did management point to as the sort of key overall drivers for this strong quarter?
They really emphasize good execution across the board and just continued strong demand in all their main end markets. Commercial aerospace, biz-av, military helicopter.
Commercial aerospace was particularly strong, right? Up 18%.
Yes, driven by major platforms needing engine work. And they made a really interesting point addressing some of the broader chatter you might hear about airline capacity.
What was that?
They stressed that the critical engine maintenance they do is largely non-discretionary. It's not something airlines can easily put off, even if passenger traffic fluctuates short term.
That's a key point for understanding their resilience, isn't it?
Absolutely. It suggests a strong baseline of demand. They specifically linked this back to the strength they saw in programs like the CF-34.
Okay. And the other markets, business aviation?
Also strong, up 13%. Good demand across midsize, super midsize, and large cabin jet engines. Military grew 10%. That got a boost from the Aeroturbine acquisition they did, plus growth in the J-85 program.
Yeah.
They mentioned the stability they get from core platforms like the C-130 transport and Every's fighter jets, F-16, F-15EX, the T-38 trainer.
And these military programs aren't really affected by current events like Ukraine.
They specifically said these established programs aren't seeing a material impact from that right now. It provides a stable underpinning.
So, diversified growth, solid demand. Where did that overall company margin expansion come from then, if engine services margins were flat?
Right. It was a few things working together. Overall revenue growth helps to leverage fixed costs. Then you have pricing actions across the business, productivity initiatives kicking in, and importantly, that favorable mix shift towards the much higher margin CRS segment we talked about.
So CRS pulled the average up significantly.
Exactly. And even within engine services, while LEAP and CFM 56 had those initial lower margins, they apparently had a favorable work scope mix on other engine programs that helped to offset it somewhat.
It really highlights the benefit of having such a diverse portfolio, doesn't it? Servicing over 40 engine types across different markets.
Yeah, they position themselves as a leading independent MRO provider, which helps them navigate, the complexities of the global aerospace market.
Okay, let's talk investments and strategy. Where are they focusing their efforts and capital? The LAP program ramp seems huge.
Definitely a major focus. They reported good progress there. They hit their first CIM delivery. That's a customer integration module. And they inducted the first full PRSV piece part repair shop visit engine. That one's due for delivery later this year.
So, hitting milestones.
Yeah, they feel they're on track for the final industrialization steps in that first PRSV delivery in the second half. Big news was also securing 6 new LAP customer contracts in Q1.
How significant are those?
Representing over 150 shop visits combined. That pushes their total LAP backlog now over $1 billion.
$1 billion in backlog already. Wow. Any supply chain issues mentioned for LAP?
They said no significant holds yet, which is positive given how common supply chain snags are. They also got key regulatory approvals sorted in places like India, Japan, and the UAE. Critical for doing the MRO work.
Okay, LAP is clearly central. What about investments in their more established core programs like CFM 56 and CF 34?
They're really leaning on the new capacity they built out in Dallas for both of those. They had that record quarter on CF 34, which came after expanding their relationship with GE.
And CFM 56.
They're adding new customers there too, mentioned Lion Air specifically. And here's a fascinating point they made. StandardAero is apparently one of the few independent MROs actively adding CFM 56 capacity right now.
Really? Why is that significant?
Because the CFM 56 has the largest installed base of any engine ever. And they estimate something like 40% of those engines haven't even had their first major shop visit yet.
40% still haven't had their first overhaul. That's incredible. Points to a really long runway for maintenance demand.
Exactly. A very long tail.
Okay. You mentioned the CRS expansion earlier. What are the strategic moves there?
They're focused on growing their component repair capabilities, the higher margin stuff. Developing new repairs for LEP components is one piece, but also growing high-value repairs across all sorts of platforms.
And how are they doing that? Just selling more repairs?
Partly selling to third parties, yes. But a key strategy is also insourcing more component repair work from their own engine services segment.
Bringing it in-house instead of sending it out. Why?
Better cost control, faster turnaround times for their engine overhauls, and crucially, they capture that higher component repair margin internally instead of paying someone else for it.
Makes sense. And that ties into the facility consolidation and exiting the hydraulics line.
Precisely. Consolidating to get more capacity for these higher value repairs and shifting resources away from lower margin work. They actually described component repair opportunities as a bottomless well, working closely with the engine makers.
A bottomless well. Sounds like a big focus. Do they talk about M&A, acquisition?
Yes. They confirm they're still actively looking. They see a growing pipeline of potential targets and feel they have the balance sheet capacity to do deals.
What are they looking for?
Discipline is key strategic fit. Potential for synergies. They mentioned the M&A environment seems a bit more robust lately, with attractive targets popping up in both engine services and CRS. And their current leverage gives them room to pursue those.
Okay, so strong Q1 performance, investing in growth both organically and potentially through M&A. How did this translate into their financial outlook for the full year? Did they update guidance?
They did. Given the strong start and their confidence in demand, they raised both sales and earnings guidance for 2025.
What are the new numbers?
New revenue range is $5.825 billion to $5.975 billion. And the new adjusted EBITDA range is $775 million to $795 million.
And does that raised guidance account for potential headwinds like tariffs?
Yes, they were clear about that. The guidance includes an estimated net negative impact from tariffs of about $15 million.
So they're confident enough in the underlying business to absorb that and still raise.
Seems so. They said the guidance increase is mainly driven by the continued strength they're seeing in that core engine services aftermarket business.
What are their growth expectations now for the different end markets for the full year?
They're projecting commercial aerospace growth in the low double digits to mid-teens, business aviation in the high single digits, and military helicopter also in the high single digits.
So still expecting strong growth across the board.
Yeah, overall continued double-digit revenue growth for the company and further adjusted EBITDA margin expansion for the full year.
Let's circle back to cash flow. We talked about the Q1 use. How does that fit into the full year picture?
Right, that $64 million use in Q1 was basically right on their plan, mainly due to that seasonality working capital investments taxes.
So the strong earnings helped, but other things offset it.
Exactly. Strong earnings and lower interest costs were positives, but offset by those working capital needs and also higher CapEx spending.
Ah, CapEx. What were they spending on?
The capital expenditures were targeted at those strategic growth areas, included a $15 million payment for the CF-34 license expansion, and another $36 million went towards tooling and equipment for the LEAP and the new CFM56 capacity in Dallas.
So significant investments in those key platforms.
Yes, those major platform investments are budgeted at around $90 million for the whole year. They expect the spending to be weighted more toward the first half, so Q1 fits that pattern. They're still on track for the full $90 million.
And longer term, what's their target for leverage?
They're aiming for a net leverage ratio between 2 and 3 times adjusted EBITDA, and capital allocation priorities remain organic growth, funding those new platform wins like LEAP, and finding smart accretive acquisitions like ATI was.
Okay, shifting gears slightly to the bigger picture, macroeconomics, geopolitics. How are they navigating that? Tariffs, for instance.
On tariffs, they're actively managing it. That $15 million estimated net impact is baked into the guidance. They're mitigating through contractual pass-throughs where possible, pricing actions, and internal cost improvements.
Any specific exemptions?
Yeah, they noted work done in Canada is USMCA compliant, so it's exempt.
Yeah.
And for US-based work on international customer engines, they see lower exposure because of progress in broader trade talks.
What about that Section 232 investigation related to MRO that surfaced recently?
They did address it, said it was very new, only known for about 72 hours at the time of the call. So too early to really speculate on what it means. Scope, outcome, all unknown. They suggested it's probably tied into those wider trade negotiations.
Okay, too soon to tell on that one. They also had an interesting take on operating in harsh environments, didn't they?
Yay, kind of counterintuitive maybe, but they view operating in dusty, sandy, or saltwater environments as actually good for their business.
Good, how so?
Because those conditions wear engines out faster, meaning they need maintenance more often. It drives volume for them. And they use their huge database on engine performance in different conditions to factor that accelerated wear into their pricing models.
Huh. So harsh environments can actually be a tailwind for MRO demand. Okay, we've covered a ton of ground from this call. Let's try to synthesize the key takeaways for you, the listener. What really stands out?
I think first off, these results really underscore the strength of their diversified model. Being in different engine types, different end markets, it helps them navigate the ups and downs.
And that non-discretionary point seems critical too.
Absolutely. Emphasizing that core engine MRO has to happen provides a level of stability, even if you hear concerns elsewhere about airline capacity or whatnot. It makes their demand profile pretty resilient.
It also sounds like they're executing well on their plans.
Definitely. The progress on LE, the expansion in CFM56 and CF34, and especially that really strong performance and margin growth in CRS, these aren't just Q1 wins, they're setting the stage for future revenue and profitability.
And raising guidance while absorbing those tariff costs definitely sends a strong signal.
Yeah, it suggests confidence in their operations and the underlying demand they're seeing. Plus, their focus on capital allocation, organic growth, new platforms, smart M&A points towards continued value creation efforts.
All right, before we wrap this up, it's time for our segment where we play around with an idea based only on what we heard in the call. And remember, this is absolutely not financial advice, purely a thought experiment for entertainment.
Crucial disclaimer.
Indeed. So here's an outrageous but plausible idea sparked by this call. We heard Component Repair Services, CRS, is knocking it out of the park with 28% margins in Q1. Management loves it, calls it a bottomless well, and is pouring investment in.
Right. High margin, strategic focus there.
Meanwhile, the bigger engine services segment is growing well, but margins are flat, specifically held back by the initial costs and lower profitability of ramping up huge programs like LEAP and CFM 56. They explicitly said these are dilutive now, but will be good long term.
So you've got this clear divergence internally. High-flying CRS margins, well, engine services absorbs big ramp costs.
Exactly. So the wild idea, could you structure something to play that internal margin difference? You can't buy just CRS stock, obviously, but maybe some kind of complex synthetic trade or a pair trade. The concept would be to bet on the continued margin strength and outperformance of StandardAero's CRS-type activities relative to the near-term known margin pressure from the big engine ramps.
That's definitely thinking outside the box. It forces you to look inside the company's results, beyond the consolidated numbers. You'd need a really deep understanding of those LEAP and CFM 56 margin curves as they scale versus the drivers keeping CRS margins so high, the productivity, the pricing, the insourcing benefits, that endless repair opportunity.
Precisely the kind of detailed thinking this call invites, even if just as a mental exercise. Okay, let's bring this deep dive home.
So wrapping up, StandardAero had a really strong start to 2025. Double-digit growth, expanding margins, they raised guidance. It points to solid execution and healthy demand.
Key strategic investments in AA, CFM 56, CF 34 capacity, and especially growing that high-margin CRS segment, seem to be positioning them well for what's ahead. That diversified model looks robust.
And one last time, none of this was financial advice.
Definitely not. And here's a final thought for you to mull over. Given StandardAero's view on the non-discretionary nature of core engine MRO, how might that potentially insulate this part of the aerospace sector compared to other areas that might be more sensitive to economic shifts or airline capacity adjustments you read about?
Something to chew on as you look at the broader industry.
Thanks for joining us for this deep dive. We'll catch you next time with another look inside the numbers.